All right, so let's go over this fundamental report, just do a quick recap, and then I just want to do a kind of a general broad overview of the total market cap and kind of what I'm seeing, the similarities between 2023, 2024, and then now ending 2024, heading into 2025. I'm kind of seeing similar things unfold, and I was being called crazy. I remember this clear as day. It was right after I lost that $500,000 in capital. It was in October of 2023 when the platform that I was on got rug pulled. And then I started fixating because I stopped trading because I didn't have any capital to trade in FX because I got freaking rug pulled. It allowed me to really focus my attention on for like a solid 4 months the crypto markets. And I was the one that called. I said back in February or January and February of 2024, I said the markets aren't going to continue to go up because interest rates are starting to shift. The expectation that the Fed is going to cut rates is starting to be pushed back, and we started to see higher inflation. And sure enough, in March 2024, that's when the market topped out at $2.6 trillion or 2.7, give or take. And we started to see a more hawkish Fed push back on rate cuts. And that started to dwindle the optimism in the markets that led or started the significant pullback all the way down to $1.7 trillion. All right. And so I just want to talk you guys through how I'm right now seeing similarities. For example, we have been pretty much extending now for August, September, October, November, December. If we go into January for another positive month, that's 6 months of positive price action. We're due for some sort of correction, and it's okay if we see that, right? For example, this most recent correction that we saw in mid 2024, let me get rid of this so you guys can see the price action broader. There we go. Everybody was fearful. Everybody was saying that Bitcoin was going to tank. Everybody was saying that the markets were going to freaking disappear. Crypto's a scam again. But in reality, the market was just resetting itself at a discount and then continued the uptrend, right? So we have to be prepared and understand that after this expansion in price, as we head into a new year, we could see or be on the verge of experiencing some type of slight correction to continue the overall trend. And in the short term, this correction is going to be caused by fundamentals. It's going to be caused by painful factors that weigh on the prices of digital assets if it unfolds again. But in the short term, it's going to be painful, long term positive. And so I just want to kind of show you guys why I'm thinking that something like that could unfold. Also understanding that the markets don't just go up for forever. Okay. And I've also been an advocate of pointing out that a lot of people think that the bull market is here now, right? Which is, it's logical to think that. But if you actually zoom out and you're a sophisticated investor, you understand that the markets have actually been going up since November 2022, which is over 2 years. So a lot of people now think, and I talked about this before, that the bull market is starting now, that we are at a high, when in reality, the bull market started 2 years ago in November when the market bottomed out at 750 billion, right? So again, I'm just starting to piece puzzle pieces of the puzzle together to really see that we could, if the fundamentals account for it, which I'll go over, be on the premises of a significant market pullback or a correction of this most recent bullish move. And if not, and what I'm projecting doesn't come into fruition, we'll also know how to gravitate towards that because we'll see it in the fundamentals. We'll see that the fundamentals support a continued risk on environment instead of a risk off environment. All right. So that's what I was really trying to convey in today's fundamental report. So let's jump into this. And then, so hopefully after this call, that's what you guys learn. And then throughout the entirety of this week, as we digest the daily fundamentals, we'll fixate more so of our attention on intraday factors. So let's start down here. Key drivers of market sentiment last week. Let's do just a quick, recap of last week. So in previous weeks, we maintained a calm and informed approach amid concerns about the recent market pump. Remember, a lot of times in previous weeks, like I'd say mid-November, end of November, you guys kept asking me, should we take profit now? What's going on? And I continuously told you guys, the market's most likely going to continue to go up as long as the sentiment remains risk on and the technicals support higher prices. That means no previous higher lows have been broken and the market sentiment remains and prevails risk on as the market prices in rate cut optimism, central bank liquidity injections into the market via Chinese stimulus, Japanese stimulus. We also saw What else did we see? Ceasefire talks in the Middle East in November as we rolled over into December, positive regulatory environment surrounding President Trump's position on the market, so on and so forth. Like there no fundamentals have weighed on that aspect of optimism yet, right? Then last week in particular, we had the optimism fueled by labor market data. So we did have some employment growth. We did have some wage inflation remaining steady in the United States, but then the unemployment rate came out and we saw a slight uptick in the unemployment rate, which showed continued signs of cooling in the US labor market. And we've heard key Fed speakers mention that under continued cooling labor market conditions, the Fed would most likely continue to cut rates to support the labor market and the US economy. And that continued to raise hopes for a December rate cut. So as it stands, as we ended the market week last week, because crypto doesn't close, but FX markets and stock markets close. So last week, as the market ended on Friday, Saturday, we are seeing the market continue to heavily bet on a December rate cut, with the probabilities last week increasing over 80%, according to the CME Fed Watch tool. And I'd also mentioned to you guys in previous reports that this is a key indicator. So think of this indicator in terms of 0 to 50 being negative and 50 to 100 being positive. So anything above a 50% chance of an interest rate cut from the Federal Reserve, and the market usually prices in a risk on market mood. Anything below, so if like this week we saw that chance go from 80% down to 50% or down to 60%, inching its way closer towards 50%, maybe even breaking 50%, going to like 40% to 30% chance of an interest rate cut from the Fed, then we'll start to see a pullback in risk assets as the markets start to price in a higher for longer interest rate environment, right? You guys kind of see how that dynamic works, that metric works to gauge risk sentiment, all right? So even though the market's dialed back, so not only last week do we have Federal Reserve rate cut stance increase, so probability of higher chance of Fed rate cut in December increase, but then we also saw major central banks like the ECB and the Bank of England also further support rate cuts. So on a global scale, right? I shared that video clip in last week's report on Friday, where the global head of research, I believe she is from Signum, mentioned that the key driver in risk assets is central bank liquidity expansion, right? This lower interest rate environment, liquidity injections into the market, quantitative easing that is starting to unfold, okay? And so if on a global scale, not only is the Fed continuing to cut rates or signal that continued rate cuts could happen in 2025, but other major central banks as well do the same. This is also going to be supportive of a risk-on market environment. So last week, we also saw the Bank of England mirror that stance, where Governor Andrew Bailey came on. He kind of dialed back expectations for rate cuts from the Bank of England in December, which did bring some strength back to the Great British Pound, as we saw some of our traders in the Discord and the GBP USD chat capitalize on. We also went on that last week in the Zoom call. But Governor Andrew Bailey, bottom line, still supported further rate cuts in 2025, which tends to also boost risk sentiment. And then same thing from the Euro front, dwindling economic activity and data across the Eurozone has also supported a further interest rate cut from the ECB. Now, there is a debate on the table whether that cut's going to come in at 25 to 50 basis points, but still cuts either way remain on the table. All right, so major central banks are still positioning themselves to further cut rates in 2025, albeit the market is kind of in that indecisive phase where we're starting to try to have to figure out how aggressive that is going to be. So just keep that in mind. Now, I wrote this portion here. So lessons from the past. While last week's market sentiment leaned more so towards risk on environments, we must remain cautious because historical patterns continue to offer favorable lessons. Look at past historical data. Keep in mind that the market repeats itself. What do I mean by that? I've been an advocate of trying to teach you guys why it's so easy to study fundamentals, because the same fundamentals come out every single month. It never changes. So once you learn unemployment claims and what that does to the market, you know it for next month and the month after and the month after, because it's the same data that comes out. CPI, PPI, we're going to get the same thing in January that we're about to get this week. Core PCE, same thing. Unemployment claims, NFP, we know always comes out at usually the first week of the month. unless there's like a holiday schedule at the latest the second week of the month. So we know in January we're going to get the same thing the first week of January, and same thing in February, and so on and so forth. The Federal Reserve literally releases their schedule, so we already know when the freaking interest rate decisions and what day of the weeks they're going to be on. Okay, so just understand that the reason why it's important to pay attention to historical data fundamentally and see how markets reacted via risk on, risk off sentiment is because we're going to get the same data. So we know if it comes out supporting a risk on environment, how to react, in a supportive or a risk off environment, how to react, because the data, it's recyclical. Does that make sense? Hopefully it does. All right. So for example, at the end of 2022, we're going to get into this. I'm going to physically open up the charts and kind of show you guys market optimism surged due to lower inflation and dovish signals from the Fed. There's a long video breakdown that I posted in one of the fundamental webinars that we had where I ran through this for you guys. I will try to find it and I will post it in the Discord where we physically broke apart from 2022 up to 2023. And I showed you guys with pictures and screenshots of all the fundamentals that drove risk sentiment and then what made market correct in 2024 in March. So I'll find that Zoom call for you guys and I'll post it in the chat for you new members so you can watch it. It is very informative, but that's what I'm talking about. So as we ended the year in 2023, the markets were extremely optimistic and they surged due to lower inflation and the market starting to price in interest rate cuts in 2024. I don't know if you guys remember that, but at the end of 2023, we started to see the market continue higher, and the markets were expecting interest rate cuts from the Fed at the beginning of 2024. However, that changed early 2024 because early 2024 brought higher inflation readings, which led the Fed to start to signal a pushback on rate cuts. And this shift caused significant market pullbacks, with the total cryptocurrency market cap dropping from 2.6 trillion down to 1.7 trillion by August 2024. We'll get into that in just 1 second. So don't forget that. We'll touch back on that when we pull up the charts. Today, I'm starting to see that similar dynamics may be unfolding. The market is optimistic right now about continued Fed rate cuts, right? Aggressively pricing in rate cuts. But I've been an advocate of telling you guys to pay attention to upcoming inflation data and key policies that President Trump could inflict in the United States that could challenge inflation. All right. So this week's upcoming focus and the metrics that we need to be paying attention to. Key data points to watch this week include Consumer Price Index, or the CPI, Producer Price Index as well, the PPI. And so I wrote here, if these figures this week show higher inflation than expected, don't forget it will be the second consecutive week that that has happened. It could, or month, excuse me, that that has happened because last month we got higher CPI and PPI readings. It could signal to the Fed that further rate cuts might be delayed or even possibly worse, reversed, where if we started to see inflation start to spiral out of control, that means month after month we start to see higher inflation readings heading into 2025, we could see them possibly bring the idea of a rate hike back to the table. And this would weigh heavily on risk sentiment, especially considering the narrative now is the market gripping and holding on and continuing to price in interest rate cuts from major central banks. You guys starting to kind of see how that dynamic works, right? Now, on the Japanese front, because this is also important, this week, also Japanese data remains critical focus. So Governor Ueda last week hinted at the potential rate hike during December's meeting, which could unwind the yen carry trade, which is a major driver of recent risk-on sentiment in global markets. So first off, you need to understand what the yen carry trade is. I feel like I'm beating a dead horse with this one, but it's still important for new members that might not understand. The yen carry trade has involved borrowing low-yielding assets like the yen for the past 13 years, as the Bank of Japan has been in a low interest rate environment compared to other major central banks, and they have been borrowing the yen to invest in higher yielding assets like stocks and crypto. So if the Bank of Japan decides to hike rates, it could disrupt this strategy and force investors to unwind their positions, i.e. selling the higher yielding assets, crypto and stocks, for a higher yielding FX pair like the yen, selling stocks and crypto to buy back into the yen, as the yen would start to offer higher interest rates compared to other major central banks like the Great British Pound or the United States dollar. Okay. So what we need to be paying attention to is a stronger yen, possibly leading to any decline in risk assets, including cryptocurrencies. All right. Key indicators to watch this week from the Japanese front. We have the M2 money stock, machine tools orders, tank and manufacturing index, tank and non-manufacturing index, and most importantly, some inflation data, the PPI year over year. So any resilient data or higher inflation readings this week from the Japanese front may increase the likelihood of the Bank of Japan rate hike, further impacting risk sentiment. So if we see the odds of a Bank of Japan rate hike coming back to the table and the market starting to price that in, that could create a risk off market mood. Risk factors beyond economic data still include geopolitical tensions. Any breaking news on this front could shift market sentiment rapidly, increasing demand for safe haven assets like gold or US Treasury bonds. Right? So any disruption on the geopolitical front, any major breaking headlines in the Middle East or Russia, Ukraine, or any new outbreaks of war, fear, uncertainty, and doubt also could weigh on risk sentiment. All right. So let's get back to this meaty portion where I'm sitting here and I was talking about the things that I was seeing at the end of 2023, calling this pullback into 2024, what I'm seeing now. So like I said, okay, we're on the monthly time frame. Actually, as a matter of fact, let's dial it down to the weekly. The weekly will probably paint a clearer picture. All right, so let's take a look back at 2023. 2023, if you guys remember from that previous report, for the first time, when we started to see dovish signals from the Federal Reserve, that means Reuters, Bloomberg, Wall Street Journal, all of those fundamental analysts started pumping out content on their platforms that the Fed was most likely going to cut rates in 2024, all started to happen in like October, November, and December of 2023. And you can see that that optimistic market mood drove risk assets to new highs because the market started to price in a future where we saw lower interest rates. And we know a low interest rate environment tends to boost risk asset optimism. Then, as January prevailed and we headed into 2024 Q1, the market continued to hold on to that narrative as we awaited data. In January, the inflation started to come out moderate. And then in February, January's inflationary data slightly ticked higher. So that was the first month that we got higher inflation data. Then in March, we got February's inflation data. It was, I believe, the second week of March. It was like the 12th and the 14th where we got CPI and PPI data. And that was the second consecutive month that we saw higher inflation readings because the inflation from January came out relatively upbeat. And the inflation from February that we got in March also showed signs of persistent, sticky, and troublesome inflation. And that started to dial back the expectations that the Fed was going to cut rates in Q1, Q2, 2024, right? And we can see that risk off sentiment that it started to create, where the market started to price in a higher for longer interest rate environment. So you can see here, I wrote for you guys, March 2024, we got February inflation data, which came out higher for the second consecutive month and dialed back rate cut expectations. Then throughout the year in 2024, what else did we have weigh on the market sentiment? We saw increased geopolitical tensions and escalations in April, right after the month of March, where I believe it was on March 12th, President Biden announced that he expected Iran and Israel situation to escalate. And then the day after, on the 13th, I believe it was a Saturday, freaking Iran and Israel whole entire situation popped off dramatically, breaking headlines, and we saw a massive outflow of risk assets. As the year continued, heading all the way into July/August, this last drop off the face of the earth, where we went from 2.4 trillion all the way down to 1.7 trillion dollars in 1 week, was the aftermath of the Bank of Japan rate hike and the bad data from the US labor market, where we had a really horrible NFP print on August 2nd. That sparked fear, uncertainty, and doubts of a possible recession, right? Okay, so here I wrote, this was the aftermath of the recessionary fears in the Bank of Japan rate hike. And the market then reinforced with bad labor market data the need for the Federal Reserve to cut rates. So after that turmoil was over, In September and heading into September, the market started to aggressively reprice in interest rate cuts from the Federal Reserve because of the bad NFP report. Then, in September, for the first time, the Federal Reserve finally ushered in rate cuts. And the idea of achieving a soft landing started to set in place as we got more labor market data. And the labor market data showed that it wasn't as bad as the report came out in August. So it reinforced the Fed achieving a soft landing, right? And that ignited a massive spark in risk assets because the market started to again aggressively price in further interest rate cuts from not only the Fed, but also other major central banks, while also pricing out the probability of a Bank of Japan rate hike. Now we're starting to see all of that sentiment change, and I've been keeping you guys at the forefront of this. So now think about where we're at. Just like in 2023, heading into 2024, markets were extremely optimistic because of why? Rate cut bets. Now that we're heading into 2025, I'm seeing the same dynamics and unfold. So the markets get blinded by upcoming data because they're so focused on the now. All these traders, all these market participants that are in profit, they're greed driven. And so they're just focused on the now, not playing chess with these markets. Think about it. If heading into 2025, we start to see higher inflation, we start to see a pushback on rate cuts because we see higher inflation, right? So the Fed starts to come out saying, hey, we're probably not going to cut rates as aggressively as market participants have been pricing in because inflation is starting to increase again. That's going to deliver hawkish comments and weigh on the rate cut expectation heading into 2025. Then on top of that, if President Trump comes into office and he opens up all these tariffs on major jurisdictions like China, Canada, Mexico, that's also going to drive inflationary prices higher in the United States, as the consumer in the United States is going to be most negatively affected by that. People aren't being prepared. They're not mentally preparing for that. Higher inflation, that would also push back rate cut hopes, right? On top of that, if we start to see metrics support a rate hike from the Bank of Japan heading into Q1, Q2 2025, that could also be another sentiment or a thing that creates a risk off sentiment leading to a market retracement, right? And so I wouldn't be surprised if, just like from 2023 rolling into 2024, 2024 overall was a bullish year. The market from 2024 here in January ended significantly higher compared to December 2024. Does that make sense? So even though we saw some turmoil in mid 2024, we're ending the year on a bullish note. So it only makes logical sense in 2025 at some point in time, even though 2025 could be a bullish year, it's logical to think that at some point in 2025, we're going to see some sort of market correction. All right. So I'm trying to play out metrics for you guys to show you what fundamental factors would need to unfold in order for that to happen. It's not happening now, but if we start to see higher inflation, scaling back rate cut optimism, if we start to see Bank of Japan hike rates leading to an unwinding of the yen carry trade, right? We know what things could create a market pullback. All right. And so that's what I'm paying attention to right now. And I wanted to bring that to everybody's attention. Now, I hope that I'm wrong. I hope that inflation continues to be maintained and continues to show signs of disinflation, right? Disinflationary trends continuing. I hope, excuse me, that economic data moderates itself on the Japanese front and that they don't see higher increases in inflation and they don't hike rates, right? Obviously, of course, that would be a rainbow scenario because the market would most likely continue risk on. Maybe we see some small profit taking as the year ends. Market doesn't pull back as deep as I think it's going to, and we just see a consolidation phase. And then after the consolidation phase, we see a continued leg higher because the optimism in the market remains, right? But again, I'm here playing chess with these markets. And now that the markets are at a premium and we can clearly see that, we need to be more mindful of the exposure to risk that we have now and how fragile the market could be if we start to see the risk off sentiment unfold. All right. So I just wanted to bring that to everybody's attention. Hopefully that visual gave you a little bit more of an in-depth perspective on why I think the market is due for a pullback. Now, again, to what degree that pullback could unfold, it's not, I don't have a crystal ball. But if we start to see the things that would create a risk off market environment unfold, we need to really start to consider, either reallocating positions that we're in deep profit on. For example, if you were buying soy with me at 50 cents and it were to break back below, I don't know, $2.50, I would possibly consider taking some profits off the table, maybe, just in case it goes back down to a dollar or something significant. You never know, right? So just be mindful of that. That's what I'm looking forward towards as we head into 2025. And you guys will continue to get updates as we prevail. All right. So outside of that, I hope I did my due diligence just to update you guys on what happened last week, why the market sentiment is still risk on. Remember, this week we have key inflationary metrics from both the Japanese front and the US front to pay attention to. For you GBP traders, we also have some GDP data from the UK that we need to be mindful of, but I didn't want to bring it to anybody's attention. I'll write about it in tomorrow's report. Outside of that, I think that that's all I got for you guys. I'm working on some things for the Wealth 28 Club members with Flair. I have a meeting with one of Kareen's mentors who she mentioned knows a lot about Flair. So hopefully I can learn some things from him and then bring that to everybody's attention in the community in the Wealth 28 Club. We got Kevin working on some content for you guys on some platforms that he is mature on in the DeFi space. So you guys can look forward to that in 2025. If you're a Wealth 28 Club member, he's going to be making some content for you guys. Aqua just dropped some content on Algorand for you guys.